Hi, my name is Safi, and today we're going to spend a little time talking about assumptions as it relates to business planning. This is a presentation that's part of the Masters of Entrepreneurship program through Western Carolina University. When we talk about assumptions, we're really talking about the foundation of your financials and your key to a successful business plan. What are the elements of a business plan? You have your executive summary, which is your overview, a detailed company description, information about your products and services, your market analysis, strategy and implementation as it relates to marketing and operations, and details about your management team. Who are they and why are they important to the success of the business? And finally, what we'll focus on today, your financial projections. As an investor sits down with your business plan, this is the area that they will come back to. So let's look carefully. When you look at financial projections, you're taking out your crystal ball and you're predicting 1, 3, 5 years into the future what your financial situation will look like. You'll include a profit and loss statement for each time period, cash flow projections, and a balance sheet. And the investor really wants to know where you got those numbers from. On what assumptions are you basing this information? So let's look closely at this. Your assumptions are the building blocks of your financial projections. So they need to be solid, well-researched, and defensible. You'll include your sources of revenue, where the money's coming from, your sales projection, how much is coming in, variable costs to run the business, fixed costs to run the business, your startup costs. Then you're going to include your investment requirements. How much do you need to get started and keep going until you break even? And then your plans for where you're going to go to source this money. As we explore each of these in a little bit more detail, we'll start with sources of revenue. This is pretty simple stuff. You got products that you sell, services that you provide, or both. And then hopefully you've got a unique business model that captures the interest, needs, and imagination of your customers and community as well as your investors. Well, moving on to sales projections. How much money do you predict is going to come in to your business? And how do you figure that out? Well, each business is a little different, so each method should look a little different. I've included a few methods here for retail businesses, simply because a retail business is the business I've been working on. So method number 1, what's the average sales volume per square foot for similar stores and similar locations of a similar size? Keep in mind that this isn't the final answer for adequate sales forecasting, since a new business won't hit that target for perhaps a year. Also, just because it's similar store location and size doesn't mean it's the same. Look for potential variables. Another method. For your location, how many households needing your goods live within a mile? How much will they spend on these items annually, and what percentage of their spending will you get compared to competitors? Be able to explain why. This is really important. You can expand to 5 miles, 20 miles, depending on the size of your business and your target population. Finally, I've included another method that's a combination of a business that provides multiple goods and services. So if you offer 3 types of goods plus 2 types of extra services, then you're going to estimate sales revenues for each of your 5 product or service lines. Make an estimate of where you think you'll be in 6 months. We should be selling 5 of these a day, plus 3 of these, plus 2 of these. You get the picture. Then calculate gross sales per day and multiply that by how many days you're open a month. Online, 30 days is fine. If you're a retail store closed a couple of days a week, you need to take that into account. Now let's look at expenses. Variable costs are those costs that change as your sales move up or down, right? So I've included a list here, not an exhaustive list, so make sure you make your list unique to your particular business. Wages could be variable costs, especially if they're on commission, inventory, packaging and labeling. Utilities. If you're creating a product making a product on site that uses water or electricity, the more you make, the more you use. Raw material, same thing. If you're having to ship your item, then postage or freight will increase the more you ship. And then etc. just reflects the need to make this unique to your business. Fixed costs. These costs don't change as the sales change. Amortization. This is an accounting term that refers to gradually expensing out the cost of an intangible asset over the useful life of the asset. So this includes contracts, trademarks, domain names, customer lists, things that you can't actually put your hands on per se and have a function. Depreciation is the tangible form of this particular method. So gradually charging to expense the cost of a tangible asset over the useful life of the asset. So if I'm a farmer, a depreciable asset is a tractor. If I'm a printer, a printing press. Insurance. Probably several forms of insurance you need to carry. Know what they are and how much they cost. Rent. Self-explanatory. Property taxes, same thing. Salaries. Now it's important to differentiate between salaries and wages. Salaries do not change regardless of how many hours are worked or how much sales are made. Loan payments, interest expense. Again, not an exhaustive list. Know your business and include what's relevant to your business. Startup costs. Now for me, this is kind of the exciting stuff because this is the stage that I'm in with my business. You're going to need money to really fuel the seed of an idea, the seed of a business, and get it up and off the ground. You probably are going to have legal fees, site selection, lease fees, construction costs. Either you're building a new structure or you're refurbishing or changing an existing structure. Maybe you have tools and equipment to purchase. This could include computers. If you're a farming business, this is tractors, fixtures and furniture, logo design and signage. Also website design is going to be included in here. And then marketing materials and advertising. Know what's unique to your business and make sure you include all of those startup costs. So we've really evaluated at a detailed level the financial needs of our business. We know now what we need to get this business up and running and to keep it running until we hit break even. So we know what our investment requirements are. We know how much money we have to put in the pot. Once we know this, then we can plan for where we're going to go to get our money. We should have our own nest egg. Each investor is going to expect that of us. They need to know that we have skin in the game. We could also look to friends and family. Beyond friends and family, there's the option of community capital. I'm not going to say too much about this now, but look for another presentation about bootstrapping your business. There's some creative ideas floating around now for how to fund small businesses outside of traditional means. And traditional means will include financial institutions, loans, maybe it's a small business loan, and potentially angel investors. If your idea is one that's fast grower and promises a nice return on investment, then angel investors may be your ticket. This really concludes the assumptions part of your business plan, but I can't really overemphasize how important this is. You'll be providing spreadsheets that detail your financial projections, but you should also provide a separate document that outlines where your assumptions came from. What are your underlying premises that back your numbers? The more detailed, the more solid those are, the more confident an investor will be in your particular business. So I hope this information has been valuable to you, and I appreciate your time.